As we spoke in the weekend stock update, we expected stocks to continue to rise. And on Tuesday, U.S. equities soared, sending the S&P 500 and the Nasdaq toward their highest close in a month. And read in between the lines, the Fed is now getting added pressure from politicians to pivot. If the Fed pivots, that would rocket stocks higher. But the fate of any rally, if only for the next few days, appears to be in the hands of the mega tech companies reporting earnings this week. As I record this video, Microsoft and Alphabet, and by the way, Alphabet is a really stupid name for a company. Google was much better. The only name worse than Alphabet is Meta. But back to Microsoft and Alphabet in the after-hours trading, both are struggling. And recently, KeyBanc joined Bank of America in cutting its price targets for the mega stocks, highlighting skepticism of revenue growth and the mounting concerns of a downturn in 2023. And JP Morgan's Mega Cap Tech Index, which includes Netflix, Google, Apple, Amazon, Microsoft, Nvidia, and Meta, has collapsed 40% year to date. And so today we're going to take a look at the tech stocks through the Nasdaq proxy. And two charts today, beginning here with the 20-year monthly on the Fidelity Nasdaq Composite Index ETF, and this serves as a pretty good proxy for the Nasdaq. And the symbol in the upper left, as you can see, is ONEQ. And the close on Tuesday was 43.90, and of course we had the top in the market at that point there, and then the big drop down here to the 50 EMA. We kind of have a double bottom, perhaps there and here, and yes, we did go below my lines here, but by not too much. And as you go back here in time, you can see we had that there that held at the 50. This held. This more or less held, and here too. Back here in 2011, we did go through in 2010, and of course we went through in 2008 and 2009. But I think that there's a fair chance that we might hold this. At least it's looking pretty good right now, but I do think that we're going to have volatility, and that is shown here by the MAC. Definitely that top in the market there, we saw that it ran through. When we the fast line ran through the slow line, that was heads up to everybody. So I've been on the sideline just watching this. Hopefully you all have been too. But the fast line is down here, just piercing below the zero line, and then of course the slow line is way up here, and that differential means volatility. I think things are going to start repairing here soon, as you can see in the histogram, but that still means volatility. Again, a little bit of a start of a bottom and basing here for several months, but I think we're so deep into this negative territory at -2, I think we're going to need a lot more time to heal. Moving on down here into the price rate of change, you see this fish hook here with an attempt to move on up, but there's still a big separation between the slow line there and the fast line here. So anything can happen. Again, that sort of indicates volatility. But here into the RSI, we're at a relatively weak 38.97, but it does look like a better bottom and basing is occurring with, say, some slight improvement. We'll just have to wait and see, but it looks encouraging. And then here into stochastics, perhaps maybe the initial stages of a bottom and basing. But going back here to 2008, 2009, you see that the turn can be quick, and with the fast line moving on up. So it's possible that things may change very quickly. That doesn't necessarily mean that the bottom in the market has been made, but it is an indication. Another indication here is the Williams. The Williams has had a little bit longer time down here in that oversold territory, hasn't made its way out. I want to see that make its way out and up here to the 50 or midline and head on up, and that will pull other oscillators with it and give you another indication. But let's close in on a little bit shorter time frame. For this second chart, we're still using the ONEQ, but we're looking at a 3-year weekly chart now. And what's important here is basically this channel. I'll draw it the best I can with the bottom trend line moving through like that and the top trend line moving through like that. So as you can see, we've had 1 attempt, 2 attempt, at least 3 major attempts to break up and through that trend line, and it's not been successful each time. We've gotten turned back down to the bottom trend line, and now it looks like we're having another move on up. We'll see where it goes. We still have to tangle with the 20 and the 50 EMAs before we get to the trend line, so we have some time. So let's just see and wait to see what happens. We need to break up through this top trend line for me to believe that perhaps we have a better chance of continuation of a rally. But for the most part, we should be rallying here in the next few weeks or so. But again, we have the big techs this week, and that's going to create some volatility. Into the MAC, you can see I like this bottom and basing here, and then of course I like this level here, which is higher. That shows definite improvement, and I really like that. The same improvement you can see in the histogram all the way through here, as well as into the price rate of change, the relative strength index, and of course the stochastics and the Williams. The Williams still needs to head on up through that 50 or midline for me to be convinced that things really are improving. But I think we have a mixed bag here. Some of these oscillators are showing things are improving. But once again, the monthly chart, we need to solve that bottom and basing, and I still think we have some time. So we may have these rallies, but if we don't get above that trend line, we might get turned back for another down leg, and then we'd have to try it once again. So just be patient as usual, because there's going to be a lot of opportunities. And for today, that's ChewDog Charts. Thank you.